Welcome back to Stock Market Weekly, episode 698 for Friday, September 15th. My name is Evan, and here's what I got for you in this week's episode. Back-to-back inside weeks for the S&P 500 Nasdaq 100. That is really the top, most interesting story here from a technical perspective, really sort of illustrating how kind of compressed, sideways, choppy this market has gotten, and we're going to look at that in just a moment. Yields also pressing back up towards their cycle highs as we've kept a close pulse on them over these past handful of weeks, months, year, really. This continues to be an interesting story to follow. Oil bulls continuing to run away to the upside here, unobstructed, consecutive weeks of good, strong gains there out of energy. Meanwhile, you have technology. Apple, the behemoth, the heavyweight, the mega cap is back to testing its 4-month lows, feels a bit heavy, and semiconductors rolling over on Friday. We're going to look at all of these charts here in just a moment, so stay tuned. All right, we are back. We've got some charts in front of us. And for those of you who are new to the series, tuning in for the first time, our goal here is really to just break down the most important trends, price action, noteworthy moves across financial markets 1 week at a time. Today, we are looking at Warden TC2000 here, our sort of preferred charting platform. We've got lots of tools, indicators, custom scans, all kinds of cool stuff, gadgets, and widgets that you can install if you are a user of this platform. So check out our website if you are a TC2000 user for more on that. Now, let's get into the numbers here. If you follow my mouse up here, 1 week returns red across the board, but not by a whole lot. I mean, really just sort of a choppy sideways week. If you look at these charts here, this is the 5-day action. So just essentially a line chart of the week's action. And basically you just see essentially this little roller coaster here, just a seesaw up and down, up and down. Thursday, we had a nice run up in markets. Things started to get, their acts together, so to speak. And then Friday, the bottom sort of fell out. It was quadruple witching day, lots of options expiration on Friday. But essentially stocks were firmly red on Friday, gave up all of the week's gains and then some in some cases. So everything was down this week. Nasdaq led the charge, down 0.5%. If we take a look at our volatility indices here, pretty flat on the week. So NASVOL is just under 20, 18.77. VIX going out at 13.9. So really not a tremendous amount of fear out there in the markets right now. Still very complacent volatility readings. If we take a look at the sectors this week, again, you can see utilities at the top of the list here. So this is kind of new and emerging here. They're on a nice run over the past 5 to 10 days, followed by consumer discretionary and financials, all up 1.5% to 3%. And at the bottom of the list is technology, down 2.25%. Really the big standout loser was technology this week. I mean, that's what kind of dragged everything down, but as you know, tends to be the case, a lot of traders, active investors tend to be focused on this sector the hardest. So certainly where most of the attention lies is what got hit the hardest this week. Industrials were down a little over 0.5%, materials down just slightly. If we take a look here at our trends of sectors. So this is our smart trend filter. It's a custom indicator we have for TradingView and for TC2000 users. But you can see here that we are getting a little bit more diverse here in the sectors that are in either confirmed uptrends or sideways and negative. So basically technology, even despite all of its weakness this week, still kind of in this neutral phase, potentially going to phase down early next week. Communication services still kind of bullish here. Discretionary bullish, real estate figuring out what it wants to do. Energy is the cleanest trend. It's been like that for quite some time. This isn't new. It's certainly a little bit long in the tooth at this point, but it has been working. It continues to work. You can see financials trying to turn up right now, and everything else is kind of mixed picture. Utilities turning up this week as well. If we look at market breadth here, so bottom of our chart, this is our 52-week highs versus lows ratio. something we keep a close eye on every single week here. And it's really the same behavior that we talked about in our last video and really our last few videos. We are still seeing the number of stocks hitting 52-week lows dominate those that are making 52-week highs, but the ratio is not quite expanding to the upside. So it's in, again, this sort of treading water phase, glass half empty type of look here. More stocks are hitting 52-week lows. They're not expanding. We're not seeing more breakdowns occur, at least not yet. But this ratio, again, if you're bullish on this market, you want to see it start to flip in the other direction. You want to see more green candlesticks like we saw back in here when we had the run up in June, July in the market. That's not what we have right now, so something to keep an eye on. If we take a look at the percentage of stocks over 200 SMA, you can see, again, pretty flat line here around 46%. If we look at the percentage of stocks over a 50 SMA, we are still, again, flat and kind of sideways here around 29%. So not a whole lot of improvement here in market breadth, despite, you know, energy strong leadership and utilities trying to turn up. We're still not seeing that real sort of broad-based participation leadership as of right now. Now, if we move over to IBD, so shout out to IBD. They are a sponsor of the show. They make the show possible. So Investors Business Daily, this is their IBD 50 list. This is their top 10. And we are looking at the performance this week and last month and over the past 1 year. But you can see these stocks were hit pretty hard this week as well, mostly red and, you know, strong kind of single digit declines here for really almost everything in the top 10 here. Li Auto kind of bucking the trend, and this RELY also staying green this week. So something to note, it was, again, that technology, more growth kind of focus here is certainly where some of that pressure was hit. If you want to get access to IBD's lists, content, editorial content, check out a link in the description of this video. You can support the show and support IBD with that link. Now, let's move on here to commodities. You can see really where lots of strength was this week. Oil, 3.82% for the week. Look at the 1 month return now, up 13.9% over the past 1 month. So it really goes to show where a lot of that strength has been. Copper also doing well this week, 2.5%. DBA up 2.25%. Natural gas up 1.5%. Silver was up. Dollar was up. Gold was up. So that's a curious thing. You don't typically see correlations like that. Dollar has been very strong. Oil continues to be very strong. And so we're not seeing kind of this inverse relationship where dollar up puts pressure on commodities. We're seeing these things rally sort of in tandem with one another. You can notice on the smart trend filters here, if you besides oil, all of these other commodities and DBA, I should say, are still, have been kind of struggling over the past month or so. It's really been, oil that has been standing out to the upside. You can see copper trying to get its act together and commodity and agriculture ETF here. But natural gas, silver, gold, all still kind of struggling right now in this environment. And we'll see which way those lean in the coming weeks. Now, interest rates, yields, this is what we've been kind of following here. And what we can observe now is, most of these markets here right across the curve. So from 5-year, 10-year, 30-year out, you can see we are back up towards testing those prior cycle highs. We haven't quite broken out just yet, but certainly close, especially in the 10-year here, looking like actually almost did make new cycle highs, but not quite. What's interesting is you're seeing the MOVE index, which is basically, essentially the VIX for the S&P 500. This is for treasuries, is breaking down to sort of new lows here. And that's kind of interesting as yields are pressing up. We are getting a breakdown in treasury volatility. So something to keep an eye on. Again, I remain in the camp here that this does matter, or this ultimately will matter if yields continue to march up and we do start to get a breakout or acceleration higher in yields. I got to imagine technology specifically will start to acknowledge that, price that in. Maybe this week we are finally seeing the start of that, right? Because if we go back to our sector trends or sector overview, that was technology was the hardest hit. So maybe the market kind of looking looking at where yields are, where they might be headed, and getting ahead of this in some of the selling pressure that we saw this week. So that pretty much wraps up all the data. Let's take a look at some price action now, starting with the S&P 500. As I mentioned at the top of the video, most kind of influential thing to me here is just this compression that we've seen now over the past 2 weeks. If you observe this weekly setup here, so this is a weekly chart that we're looking at right now, where each bar represents a full week worth of trading, you can see that last week we printed an inside week, and that's just basically a bunch of jargon that says we traded entirely within the prior week's range. And that's important because it just shows that there's some indecision, there's some tightness in ranges, there's some volatility compression. And as traders, technicians, we know that volatility compression leads to volatility expansion, right? And so we had two now back-to-back weeks that were inside weeks, which just essentially means that the market is coiling here. Traders are placing their bets, they're taking positions, and we are going to see a expansion in this range in one direction. Which direction that is, we don't know. We don't know, but we can be prepared, and that's what the whole point of this is. It's not to predict the future, but it's to be prepared with a plan based on levels and the action that we're currently seeing. And right now, for me, I remain kind of steadfast in the fact that we are still in this broader context holding pattern from 4,300 down here, which was last broken out in June, and the highs up here around 4,600. This is just effectively the sideways chop that we are in right now, and it feels like the way we resolve out of this compression pattern here will get us back to either retesting the highs or retesting the lows in the coming weeks. That's the way I'm viewing this right now. So what I'm on watch for is essentially a breakout or breakdown of this inside week pattern. So more, tightly here would say 44.30 as a breakdown candidate, 45.15 as a breakout candidate, and I'd be looking to target sort of the extreme range here. That's kind of what where my head is at. Think of it as potentially a trade setup, but I'm not necessarily going to be trading the SPY specifically. I would rather just look for other individual sectors or components to individual stocks to express that idea. But that's essentially the setup I'm looking at and seeing here and observing. Really, if you go down the list to the Nasdaq 100, you've got a similar kind of setup here. You've got back-to-back inside weeks. You've got that nice vol compression that's been taking place, and we'll see how this ends up breaking out, either up or down. For the Qs, essentially 357 up to about 388. That's the level that we've been kind of observing and looking at here. So we'll see which way this ends up spilling. Again, technology has seen that weakness over really the past week or two, and we'll see if that can continue. Russell 2000 definitely looks a little bit different here. You're not getting those consecutive inside weeks, just feels heavy. Russell 2000, broadly speaking, still in this longer term pattern of sideways chop that we've been in for really the past year and a half or so, and no change of that in the near term as far as I can see. So that's what I'm looking at there for the majors. If we go to some of the other major markets here, this is IEF, the 10-year Treasury bond. And like we talked about here, as interest rates start to, creep back up towards high, that puts pressure on bond prices here. You can see we're back towards almost the cycle lows, almost taking out those 2022 lows here. Not quite, but getting there. TLT, you can look at that as well. Pretty ugly session on Friday, and just weakness and heaviness going out into the weekend. If we look at oil, you can see this is clearly where the bright spot has been. We talked about this last week. I mean, we are just cruising to the upside here. And there's been lots of opportunities all the way back here when we first identified this breakout of this 7-week sideways trading range. We talked about that. We talked about when it got over this, kind of falling channel in here back in July. We had a nice consolidation, and then we broke out of that consolidation and we're trending higher. So it's been really acting, picture perfect from a technical perspective. Look at that monthly chart. Again, no matter how you kind of slice and dice it, it just looks like a clean technical break continuation. Now, that is not to say that it's an easy buy right here. It is definitely a long in the tooth trade right now. So I'm not necessarily saying, hey, go, the coast is clear, go buy oil today. That to me seems slightly reckless, but you do have trend and momentum at your back right now. But I would love to wait just for another reset here, wait for a pullback, wait for some consolidation, and then you can either add to a position or establish one. But oil continues to work in this environment right now, despite the dollar looking pretty much the same. I mean, oil and dollar right now are pretty much trading in tandem with one another. They both have similar patterns, up and up to the right. Dollar index again just taking kind of no prisoners here and continuing to trend up. So that is really sort of the macro picture there. If we take a look at some individual stocks, we talked about Apple at the top of the video. So Apple here, continues to just look pretty bleak, not so inspiring here. It, clearly had its highs now in hindsight back up here around 197. Those were good for all-time highs. We came breaking down after earnings. We tried to rally up. We had a good rally here. I mean, it was a 10% move in a very short amount of time, just about 3-4 weeks ago. But now we quickly gave that right back, and we're back to these August lows here. So the danger sign in Apple now is we are developing a new series of lower lows and lower highs. We haven't quite got that in action yet. We've got the lower high that's at potential, but if we start breaking down below 170, we'll have a confirmed sort of structural trend down here on a more intermediate term basis. So something to keep an eye at, I should say. Apple to me though just doesn't look all that exciting. You're seeing more and more distribution days line up as well. So again, if we look at volume here, take a look at the heaviest volume days since July, since topping out here, they all are on those down days. So keep an eye on that for Apple. Next, if we look at NVIDIA, again, kind of I don't want to say a similar story because it is definitely a different picture here, but this is certainly your big market leader. All eyes on NVIDIA, can do no wrong. It crushed earnings last announcement, I should say. But now you can see that the stock is kind of mostly sideways. Definitely not breaking down like Apple, but certainly not, leading and just, ripping to the upside like it had been earlier this year. It is just looking like it's got to digest a little bit. It's had a really, really big run, over $1 trillion market cap now. So some rest here is well deserved, but really, 478 or so. This was approximate highs in July. We tried to break out of them just a couple weeks ago. We failed up here again after earnings. And now I would say, NVIDIA, I don't really see a whole lot of reason to own the stock from a momentum trading perspective until we're back over about 478 or so. Right now, it looks a little bit heavy, kind of tired, just needs some time. So when you got NVIDIA looking like this, Apple looking like this, you got to be, maybe just, again, a little more patient here, especially with technology. But if you look at the flip side, the bright spot, Tesla continues to work this week, up 10%. It's up now for the 4th week in a row. It's up basically 27% in the last month now. So really kind of coming back strong from the dead here. Had that big pullback in July, August. Big is sort of a relative term, 28%, but of course, this stock moves with some pretty good juice, but it's recovered a lot of that right now. And so it's getting back up towards its prior highs. Be interesting to see how it reacts up here as it gets closer to its July cycle highs. But Tesla, clearly the other side of the trade here, where you got Apple, NVIDIA kind of slowing down. Tesla still looks pretty strong. And, there's a handful of other names certainly that are not exactly tech, but certainly in the high beta space. So that pretty much does it for this week's episode. If we take a quick kind of ending peek here at strong industries and weak industries of note, I'll leave this screen up. You can take a look at it, some custom scans that we're applying here to look at some interesting sectors that are either breaking out, showing interest to the upside, or this list here to the downside. So that is what I have for this week. I would love to know your thoughts. Leave a comment below. What are you looking at this weekend? What do you think about this market? Leave a comment below in the video section here. And don't forget to check out those links in the description of the video for more Warden TC2000 scans, indicators, products, as well as our sponsored IBD link in the description. Thanks so much for tuning in. I hope you have a great weekend, and we'll see you back here, same time, same place next week. Take care.